I've watched real estate investors lose thousands on loans where it was too easy to close. Ever heard of the lending risk curve? Probably not, because I just made it up. But let me break it down for you. Because the truth is simple. The easier it is to qualify for the loan, the more risk you're taking on as a borrower. Let me explain. At the top of the safety ladder is your traditional Fannie Mae or Freddie Mac investor loan. This is the gold standard. You get a full underwriting, credit, income, employment, asset appraisal, reserves, the whole package. And because the lender verifies everything, you typically get the best loan terms, a 30-year fixed mortgage with a competitive rate. Down payments can range from 15 to 25% depending on the property type, but the catch is the property must be move-in ready. No rehabs allowed. These loans primarily focus on 1 to 4 unit properties. This is the safest option because the lender is doing the deepest due diligence review. Next down the risk curve is a DSCR loan, which, if you don't know, stands for debt service coverage ratio. This mirrors a lot of the conventional structure, but with one major difference. We don't look at your income or your employment. We qualify you based on the performance of the property. So basically, the property's cash flow. Rates can be slightly higher, but you can offset that by closing in an LLC and adding a prepayment penalty. These can range anywhere from 1 to 5 years depending on the lender you decide to use. Not familiar with the prepayment penalty? It is a penalty for paying off the loan too quickly. See, investors who buy these types of loans expect a return on their investment. This ensures they get their profits one way or another. It's important to know that DSCR loans close faster because, well, they're simpler. And that's great for investors who want to scale their portfolios, but because we're verifying less, no payments or tax returns, the risk is inherently higher. So now we step into the renovation territory, starting with Fannie Mae's HomeStyle Renovation loan. You still qualify like a conventional borrower, but now we're adding construction risk. Contractor bids, renovation budgets, timelines, and after improved appraisals. This is where variables creep in. Contractors' delays, budget overruns, city requirements you didn't expect, or a contractor who quits mid-project. The loan itself is safe, but the construction price is what increases the risk. Next is the fix and flip loan. Same renovation risk as the home style, but with the DSCR style borrowing qualifications. No income or employment verification, must close in an LLC, and typically short-term interest-only loans. These loans are designed for experienced investors who know how to manage construction timelines and surprises. And finally, the riskiest loan option of them all, the private money loan. This is where underwriting can be extremely light, oftentimes being done by an individual person. Sometimes there's no appraisals, no title reviews, no verification of any kind. It sounds ideal, but here's the truth. Lenders protect the money, which means by default we're protecting the borrower. Without proper collateral review, you could walk into city violations, title defects, insurance problems, zoning issues, or possibly rebuild restrictions. When guidelines disappear, risk goes way up. So here's the rule of thumb. As lending qualifications ease, risk increases. Choose the loan that matches your experience level, your project, and your risk tolerance. And if you want help figuring out which option fits your next deal, I'm always here to help.